Hey, welcome to Family Wealth Planning Partners. I'm Brian Ramsey. This is our weekly podcast series, and today's topic is how to contribute to a Roth IRA when your income exceeds the limitations. So let's first back up and talk about what is a Roth IRA. Now, I know most people have either heard about them, read about them, maybe invested in one already, but there's a couple of things you need to know about a Roth IRA. Number one, all contributions are made with after-tax dollars. So money you've already paid tax on, then you're making contributions to the account. The assets in the account, when they're invested, grow tax-free. That's a good thing. And the distributions are tax-free as well once you reach the age 59 and a half. Now, there's some other ways to get access to that tax-free. That's for another show. We'll discuss that in another topic. Your contribution limits for 2019 are $6,000 if you're younger than the age of 50. If you're over the age of 50, you can contribute an additional $1,000 or $7,000. Now, here's the key to this. If you are an individual and you make more than $122,000, you start to phase out of the ability to contribute to a Roth. Married couple filing joint, their income limitation is $193,000. So we have several clients that are in this predicament. So the question that I get is, okay, my income exceeds those limitations. How do I contribute to a Roth? The main thing that we do is we do what we call a backdoor Roth IRA. That's kind of what we want to talk about. So how do we do that? Well, we first contribute to an IRA, and we do that with a non-deductible contribution to an IRA, and then we immediately convert those dollars over to a Roth. So let's say, for example, a client puts $6,000 in an IRA, non-deductible. Then we immediately, usually the next day, move that $6,000 over to the Roth IRA. Now, this was, the ability was given to us, I don't know, several years ago in tax reform. I think it was 2010. And it said that if you have any money in an IRA, you can convert that over to a Roth IRA. Now, here's the catch to that. The government allowed us to do that because they wanted us to have pre-tax dollars, and when we convert that over, we pay tax on that money. However, it's very important to understand that a backdoor Roth IRA really only works when you're making a non-deductible IRA contribution, which means you're making it with after-tax dollars, not pre-tax dollars, and then you're converting it over to a Roth. Now, in some cases, we have clients that have money that's in an IRA and it's pre-tax dollars. We have calculations that we can work with a client on to see if it makes sense for them to move that money over to a Roth. That money that is pre-tax would be taxable to them, but it still might make sense to move those dollars over to their Roth IRA anyway. And again, there's a calculation we can walk clients through to see if that makes sense to do that. But the purpose behind a backdoor Roth IRA is to get money into a Roth IRA when you exceed the income limitations. So if you've got questions on how we do this, if you just want more information on a backdoor Roth IRA, feel free to give us a call. Or send us an email. We'd be happy to get you whatever information you need or would like, or be happy to answer any questions you have. Thanks for watching. We'll catch you next week.